Hi, everyone. This is Andrew Patnell. Thank you for tuning in. It is, of course, March 17, 2017. And, of course, what I wanted to start off with in this podcast is, of course, Bitcoin. I just wanted to highlight the Bitcoin price and the recent collapse that Bitcoin has had. It's not really a collapse, it's just a pullback from 1,300 back all the way down to just over 1,000. Not, I wouldn't panic. Wouldn't panic at all. This is certainly the time to accumulate, I believe, because with inflation coming for the U.S. dollar, that the purchasing power of Bitcoin as well as gold and silver will increase over time. So this pullback is just allowing you to get into Bitcoin a little bit cheaper. Now, speaking of a snapping back down a notch. Snap, it's when it released its IPO, it was priced around $29. So right around $30 to $29, and it's in recent weeks since its launch collapsed to right around the $18 handle. 18 now it's up at about 19.54. Here's one thing that I want to mention that a lot of people aren't realizing, and this same thing happened to Facebook. Now, I don't remember the exact price for Facebook when that IPO launched, but I remember it was heavily overpriced, and a bunch of people bought into it. And I also remember, about a few days after the launch, the price just absolutely collapsed on Facebook, and a whole bunch of people lost a lot of money. You know what I mean? Like, it was just this classic pump and dump scheme. And I see the same thing here with Snap. And from what I've read in some news articles, one of the biggest groups that bought into this are the millennial groups, the millennial generation. Those are the individuals that got all excited. Oh, Snap, its IPO's gotten released. I'm going to make a whole bunch of money. I'm going to buy it at launch, and the price is just going to skyrocket. And the powers that be that launched the IPO in the first place were like, you know what? We're going to pile all these suckers into the market, and as soon as we're ready, we're gonna drop the hammer, and a whole bunch of people are going to lose money, and we're going to become absolutely rich. So this is basically the scam that is the stock market, and that's one of the things that a lot of people don't realize is the stock market isn't really indicative to the real economy, nor is it a get rich quick scheme. Even though in a lot of places, a lot of marketing from all these different brokerages and whatnot, they'll tell you, hey, it's a get rich quick scheme, right? But it's not. And a lot of people fell victim to that, particularly the younger people. So that's just something to keep in mind next time a hot new IPO comes out. Don't buy into it. As a matter of fact, if you're going to get into it, wait until the price collapses and then get into it. Because, again, it's a classic pump and dump scheme. Now, speaking of pump and dump schemes, or speaking of scams in general, we have all across this country, we have a major pension plan problem. And a lot of these pension funds are really horribly underfunded. It may not even get funded in many places. In this particular article out of Zero Hedge, S&P confirms that New Jersey plan to pay 50% of required pension contributions is bad, maintains negative outlook. Standard & Poor's credit rating analysts for the state of New Jersey, David Hitchcock and John Sugden, apparently think that funding only half of the state's annual actuarially determined contributions is a bad thing. Who knew? So just to make sure we achieve crystal clarity here, S&P believes that adding to New Jersey's $66 billion pension underfunded liability, which would be much higher, but for a ridiculous assumption the state makes in setting its return on assets at an artificially higher rate of 7.65 each and every year by contributing less to the fund than it is paid out in benefits is a bad thing. Is it a bad thing? Of course, as S&P notes, New Jersey pension problems won't bankrupt the state until something down the road, so an A- rating is still reasonable for now. Okay, let me just make a comment about these pension plans and the type of people that actually run these plans. Because in all actuality, the people that run these plans are the same people that read the New York Times and take the New York Times seriously as a journal, as a newspaper, as a source of news. Even though a lot of us do realize that it is fake news, as well as MSNBC, CNBC, it's all fake news, right? But not everybody understands that, and those are the same people that essentially run these funds. There are a bunch of these college graduate economic degree holders that get hired in these positions that make decisions on what they believe will help the pension funds. And rather than going out and doing any real research or having any understanding of economics whatsoever, because since they've been taught Keynesian economics over real economics, they don't look at gold, they don't look at silver, they don't look at Bitcoin, they don't look at any real assets. They look at paper assets, they look at the stock market. I mean, just as I pointed out earlier, snaps. It completely snapped from $29 to $19. You know, I wonder how many people, got suckered into that in regards to thinking that stock, having that stock in their portfolio was going to help them in their retirement plans or not. Anyways, going back to what I'm talking about here, and my main point is that the people that run these pension funds should never be running pension funds. As a matter of fact, they shouldn't even be allowed to run their own checkbooks. You know what I mean? Because they're really that piss poor in investing and have no clue what they're doing, and they're just degree holders. They're paper pushers, they're circle jerkers, whatever you want to call them. They just suck. And they're making decisions that are ultimately going to lead to their customer base to working in Walmart when they're like 75, 80 years old as a greeter. It's pretty sad what's going on. And another, just to drive the point home, I have another article here out of IllinoisPolicy.org. What's driving Illinois' $111 billion pension crisis? And it's basically the same thing. Since the Illinois Supreme Court ruled in its May 2015 decision on Senate Bill 1 that pensions for current government workers can't be modified, debate over pension reform has faded from view. But ignoring the problem won't make it go away. In 2015, Illinois state pension debt reached a record $111 billion. Government worker pensions already consume 1/4 of the state's budget, and every day Illinois goes without a solution to its pension crisis. The state pension debt grows by over $20 million. The state's pension crisis threatens to burden taxpayers with massive, ever-escalating taxes to bail out a system that is simply not sustainable. And it's just like I said before. It's an epidemic. It's the same thing with student loans. Exact same thing with student loans. And if you're gonna solve the problem, you're gonna have to. there's gonna be a need for a bailout here. Another article talking about the pensions crisis is this one's out of postandcourier.com. South Carolina's looming pension crisis. South Carolina, Illinois, New Jersey. Can I ask somebody, what is 1 + 1? I mean, come on. What's 1 + 1? Seriously. Years of ill-timed investments and a refusal to abandon questionable strategies have left South Carolina's government pension plan on the ropes with a massive funding gap that threatens promised benefits to future retirees. Excuse me, I just had to cough for a second. But anyways, the plan serves roughly 1 out of 9 state residents, and the shortfall of $24.1 billion is more than triple the Palmetto State's annual budget that left lawmakers and state investment managers scramble for a fix as the burden grows for workers and taxpayers. Teachers, firefighters, and other government employees have been required to pump ever-rising amounts of money into the pension system, only to see their retirement plan become increasingly uncertain. Costs have soared for state and local governments, school districts, and public colleges. So really, by the time if they do get their pensions, by the time they do, the dollar is going to be so inflated that it's just not going to buy anything. You know what I mean? You're not going to be able to retire. You could save up millions upon millions upon millions of dollars, but at the end of the day, it doesn't really mean anything because it's just paper. It's a paper promise that is going to buy you less by the time you do get to retire. So what's the point of even saving up for retirement in dollars? You could save up for retirement in Bitcoin. You're much better off saving your retirement in Bitcoin. I'm not suggesting that you do this, but I'm just simply saying that you would be better off technically doing that. Because this country is so debt ridden, it's not even funny. It's a joke at this point. It's really pathetic. I read an article from Zero Hedge that you even have college students taking out student loans just to go to spring break. Come on. Who takes this seriously anymore? Who takes the U.S. dollar seriously? Nobody does. Think about how people treat their money. Students going to spring break, going into debt. It's like, don't worry, the government's going to take care of it. That's the whole mentality. We'll get out of this debt. It's free money. Well, Wednesday, the Federal Reserve confirmed that, no, it's not free money. We're going to raise rates by 0.25%. So now the reasoning for my little temper tantrum there is that I do want to promote this show on Rogue Money, China Ready to Depeg from China Ready to Depeg from the U.S. dollar, Rogue Money Radio with V, CJW, Bankster, Slayer, Wolf, and Ken, which was just posted today. I definitely suggest everybody to check this out. I listened to it, found it very fascinating, a lot of information. Definitely check them out. Thank you for listening, everybody. I hope everybody has a great weekend. Take care. God bless. And I will certainly see everybody hopefully sometime sooner than later. So take care and peace.